Hello, my name is Benjamin Tan, and I'm the Securities and Education course, i.e. the SEC co-lead lecturer. SEC is student-led course run by the Investment Society, and welcome to the SEC Winter Special, which is the 20-minute condensed bite-sized version of the lecture for you to brush up on your knowledge in the winter holiday.
Hello, my name is Sebastian Stewart, and I'm the co-lead lecturer along with Ben. The SEC is a finance lecture series based on the CFA Level 1, covering a range of topics ranging from equities to real estate to FX and many more. This lecture series is ideal for beginners as well as advanced and intermediate students. We hope you enjoy listening to the podcast as much as we enjoyed delivering the lectures. Thank you for all those who attended the course this year. We had a record level of registration and hope to welcome more of you next year.
Hello, my name is Louis, and I am the co-producer of IIIP. This lecture is part of a SEC lecture series conducted by SEC team, but due to the winter break, I'll be the one distributing this lecture. And before I begin this lecture, I want to let you know that the main topic of this episode is options, and I will primarily focus on explaining the concepts. For more information on various types of options and the Black-Scholes model, I recommend searching for examples and graphs online to supplement your understanding. So, here we go. Options. So let's summarize futures and forwards from the Derivatives 1 lectures. Both involve an agreement between the buyer and seller to buy or sell an asset at an agreed price in the future. The method of settlement and standardized term of the contract differs between two, but generally the concept is clear. You agree to buy an asset at some point in the future. One thing to note here is with futures and forwards, you are obligated to complete the transaction. You don't have the options to choose whether or not buy or sell the asset at the expiry date. Starting with the formal definition, an option is a derivative, the right but not the obligation to buy or sell the underlying asset at a certain date in the future at a specified price. More informally, if you buy an option, you get to choose whether you want to buy or sell the asset rather than being forced to buy it at expiration. Given the greater variability in possible outcomes, options do have more strings attached by having more features associated with the way they work. We discuss here most basic types individually first, but we will later build upon the foundational knowledge of options to see how they work mathematically and how they can be combined with complex ways later to benefit us if the market goes up or down. So first, let's list out the two main types of options available: call options and put options. Let's start with call options. Call options are simple. They are contracts that offer the buyer the right but not the obligation to buy the underlying asset at the expiry date at a predefined strike price. You would lock in a strike price today and then be able to purchase the underlying asset in the future at the strike price, irrespective of the market price. Ideally, you would want the stock's market price to go up so that you could choose to exercise the option. However, if the stock's market price goes down, your strike price would be more expensive than the market price, and you wouldn't want to buy the option's underlying asset at the strike price since it's cheaper to go into the market and pay less. As a result, you do not choose to exercise the option and only lose the amount you pay to secure the option in the first place. Next is put options. On the flip side, what are the put options? Put and call options are complements. If you inverse everything you read about call options, you have a put option. For completeness, put options are contracts that offer the buyer the right but not the obligation to sell the underlying asset at the expiry date at a predefined price. A strike price and expiry date is set for you to sell the underlying asset to a willing customer. Ideally, you would want the stock's market price to go down so that while everyone else around you has to sell for cheaper, otherwise known as a discount, you can sell your asset at the higher pre-agreed strike price and not make a loss. Of course, if the market price does go up in the end, your strike price ends up being lower than the market price, so the customer will exercise the option to buy the underlying asset at a discount to them and at a loss to you. Options really are a two-sided game of chess. One side will always win and the other will always lose. So you really want to be sure that you're well prepared to be on the winning side with detailed analysis and an eye for forecasting future shifts in market price and market opinion. Two small things about options that should be clarified before we talk about the math behind them. Options are standardized to multiples of 100 shares. You know that it means there are rules surrounding how they are traded and conditions that you have to meet in the contract. Those terms and rules are normally set by the exchange on which the option is traded on. Next, options do have a price attached to them, unlike futures and forwards. You first pay to buy an options contract known as a premium, and then you get to have the chance to buy or sell the underlying asset in question. So now we move on to intrinsic value. First, I will talk in the context of call options. In options trading, the difference between the underlying asset price and the strike price is called the intrinsic value. Let's try one simple example. Sony trades at $90 at the New York Stock Exchange. I like Sony, so I would like a call option that expires in 3 months' time with a strike price of $95. Notice here I haven't included the call's premium. 3 months later, the stock price reaches $100 and I get to pay $95 for a stock that's worth $100. So hypothetically speaking, if everything in the example scenario works out, I get $5 free profit. The value of this call option, to me, is at most $5. I would be prepared to pay up to $5 at a premium to buy this option contract so I can make some profit from immediately selling the underlying Sony stock. Notice here I say up to. If the options contract is priced at $5, then I pay a $5 premium to buy a $95 share, totaling $100 per share. That's the same as buying the underlying Sony share itself. If the premium was $4, I would be paying $99 in total per share, which I could then sell for $100 each to make $1 profit each. In options trading, here the intrinsic value of the call option was $5, or in other words, as I said, I am prepared to buy anything up to $5 to buy this call option and still make a profit. Pay attention here. The trader also knows that the intrinsic value of this option contract is at most $5. If there was no premium, which means the call option had no cost, I get full access to the $5 benefit that it offers. A trader, being a money-making person, would want to maximize their own gains while minimizing my profit, so they'll try to set the premium to as close as $5 as possible, while still enticing me to buy the option contract they're offering. Mathematically speaking, we denote the intrinsic value as IV equals S minus K, where IV is the intrinsic value, S is the price of the underlying asset, and K is the strike price. Mathematically, we now know that the intrinsic value of a call options is either 0 or value of S minus K, provided that S is greater than K. We want to be able to select either of these two values when one of these conditions is met. But how do we write it? Math provides us a tool called piecewise functions. I like to think of a piecewise functions the same way I like to think of Build-A-Bear shops. You can make your own graph the way you want it to behave, especially if nothing in the mathematical world behaves the way you want it to. So let's write this equation and then discuss its features. Intrinsic value equals to 0 if S minus K is equal or less than 0. and otherwise intrinsic value is S minus K. And I highly recommend you all search this graph in the internet. A notation that describes the curve is the use of the max function in mathematics. It's the parent of Python's very own max function, which takes in two values as parameters and selects the value that's bigger. Mathematically, we can write it such as max 0, S minus K. An alternative notation that represents the exact same max function is just to simply put a plus sign in the superscript to denote the positive output of the function, where the plus simply means that the result of the expression has to be non-negative. One other thing we have to discuss is the concept of in the money, out of the money, and at the money. Covering the concept of intrinsic value was important for defining in the money and out of the money options. If the intrinsic value for the call option is positive, we say that is in the money. For example, the owner of the option will make a profit if he chooses to exercise his Sony $95 call option in 3 months if the price of the Sony is at $100. On the other hand, if the price of the Sony stock is at 90, the call option described in the example above would be out of the money as the intrinsic value of the option is 0. Interestingly, if the price of the underlying stock was the same as the strike price, which means S minus K would be 0, and we would say the option is at the money. Notice here that we haven't discussed the option premium. You have to take the premium you pay for the right to an options contract into account. So even if you are at the money or in the money, you would have to still account for the option premium before calculating your overall profit. So do not mix up the ideas of in the money and profit. Now let's move on to the in the context of put options. Everything you read about call options can be flipped toward the put options. They are always complements of one another, which is why learning call options makes learning put options very easy. Now we can speed up our analysis. Notice here that the strike price K is greater than our underlying asset price S. In this case, our formula for intrinsic value is reversed, which is IV equals K minus S. Writing it as a piecewise function is also simple. IV equals K minus S if S is less than K, and otherwise equals 0. Again, for completion, the notation for put option can also be written as max 0, K minus S, or K minus S plus. So now we have covered the math and shapes of call and put options. Now let's move on further. Combined options position strategies. In here, first let's talk about profit and loss graphs. Let's think of a simple equation from business studies. We know that profit equals revenue minus cost. Yes, there is a gross profit, net profit, and etc. But let's just say there's one cost, the cost of an option. We have the functions for revenue. They're the piecewise functions, which we did call IV. So PL equals IV minus premium, where PL is the profit and loss and IV is the intrinsic value. From here, we will talk about short straddle strategy. We've discussed put and call options separately so far, but they don't have to work in isolation separately. In fact, they are often combined to make new strategies with unique payoff diagrams. The first option strategy we will be discussing is the idea of a short straddle. A short straddle is an options trading strategy where a trader sells both a call and put option on the same underlying asset with the same strike price and expiration date. This strategy is used when the trader expects minimal price movement in the underlying asset and aims to profit from the premiums collected by selling the options. So how do we execute? First, selling the call and put options. The trader simultaneously sells a call option and a put option. For example, let's say the price of a 1 barrel of oil is $100. The trader sells a 3-month call option and a 3-month put option, both a strike price of $100. Each option has a premium of $0.75 per barrel. Since each option covers 100 barrels, the trader collects a total premium of $150. The profit and loss dynamics. First, maximum profit. If the price of oil stays at 100, which is the strike price, until the expiration, neither the call nor the put option will be exercised by the buyers. The trader keeps the full $150 premium as a profit. Loss scenarios. If the price drops significantly. Suppose the price falls to $90. The put option buyer exercises their option, forcing the trader to buy 100 barrels of oil at $100 per barrel and sell them at the market price of $90. Loss per barrel is $10 and total loss will be $1,000. After subtracting the $150 premium, the trader's net loss is $850. If the price rises significantly. If the price increases to $120, the call option buyer exercises their option, requiring the trader to sell 100 barrels at $100 while purchasing them at the market price of $120. Loss per barrel is $20 and total loss is $2,000. After subtracting the $150 premium, the trader's net loss is $1,850. So key characteristics of this short straddle strategy is first the limited profit. The maximum profit is equal to the total premium collected from the selling the call and put options, which is $150 in this example. Second, unlimited loss potential. If the underlying asset's price moves significantly in either direction, the trader faces theoretically unlimited losses. Last is the market view. This strategy is suitable when the trader expects the underlying asset's price to remain stable or move only slightly. The payoff explanations are the central range or profit zone. If the price of the underlying asset remains near the strike price, neither option is exercised and the trader earns the premium as profit. Extreme price movement, which is the loss zone. As the price moves significantly above or below the strike price, losses grow progressively larger, far exceeding the collected premiums. The sensitivity and risk. The short straddle is highly sensitive to volatility. Unexpected price movements can lead to catastrophic losses. As such, this strategy is considered risky and requires a strong understanding of market conditions and volatility. Now we'll move on to long straddle. A long straddle is an options trading strategy where a trader buys both call options and put option on the same underlying asset with the same strike price and expiration date. This strategy is used when the trader expects significant price movement in the underlying asset but is unsure of the direction. So how do we execute? Buying the call and put options. The trader simultaneously purchases a call option and a put option. For example, let's say the price of milk is 4 pounds per gallon. A trader buys a call option and put option, both a strike price of 4 pounds and each costing 0.3 pounds in premium. Since each option covers 100 gallons, the total cost is 60 pounds. Profit and loss dynamics. First, potential profit. If the price of milk moves significantly in either direction, the trader can achieve substantial profits. If the price rises, the call option becomes profitable as the trader can buy milk at 4 pounds strike price and sell it at the higher market price. If the price falls, the put option becomes profitable and the trader can sell milk at the 4 pound strike price while buying it at lower price in the market. So maximum loss. If the price remains close to the strike price, neither the call nor the put option gains significant value. the trader incurs a loss equal to the combined premiums paid, which is £60. So key characteristics here is first, unlimited profit potential. There is no cap on the potential profit as the trader benefits from the large price movement in either direction. Second, limited losses. The maximum loss is limited to the total premiums paid for the options. Third is a market view. This strategy is ideal when the trader anticipates high volatility but is uncertain about whether the price will rise or fall. Payoff explanation. The profit zone. Profits are realized when the price moves significantly higher or lower than the strike price. For example, if the price rises to £6, the call option becomes highly valuable. If the price falls to £2, the put option becomes highly valuable. Loss zone. Losses occur when the price remains near the strike price. In this case, neither the call nor put option gains significant value, and the trader loses the full premium paid. Sensitivity and risk. The long straddle is a strategy designed to capitalize on volatility. While the potential losses are limited and predefined, the strategy requires a significant price swing to cover the initial cost and generate profit. And next, we will move on to Black-Scholes model. A gentle introduction to the Black-Scholes model. The Black-Scholes model is a Nobel Prize-winning formula used to calculate the price of options, specifically European-style options. It is one of the most famous equations in financial mathematics and provides a theoretical framework for determining an option's value leading up to its expiration. The Black-Scholes formula predicts the price of a European call or put option based on 5 key factors: stock price as an S, exercise or strike price as an K, time to expiration, which is T, risk-free interest rate for R, and volatility as a sigma. In here, the risk-free interest rate means the interest rate of a risk-free investment, which means like government bonds, and volatility the standard deviation of an underlying asset's return, reflecting the likelihood of a large price movements. And as I said before, the Black-Scholes model specifically applies to European-style options, which can only be exercised at expiration. The contrast with American-style option, which can be exercised at any point before expiration. For example, if a European call option has a strike price of £50 and the underlying stock rises to £60 1 month before expiration, the holder cannot exercise it until the expiration date. On the other hand, an American option allows the holder to exercise early and capture the profit immediately. The model simplifies the calculation by focusing solely on European options. The Black-Scholes formula for pricing a European call option is as follows. C equals S times ND1 minus K times E minus powered by RT times ND2, where C equals the price of a European call option, S equals the current stock price, K equals the strike price, and E minus powered by RT equals discount factor to present value, and ND1 and ND2 cumulate distribution functions derived from normal distribution. And I highly recommend you all to search this formula again in the internet. So breaking down the formula, intrinsic value first. If you simplify the equation by removing ND1 and ND2 terms, it becomes C equals S minus K, which represents the intrinsic value of an option. However, options have value beyond this due to the potential for price movement, which is captured by weighing terms ND1 and ND2. Second is discounting. The strike price K is discounted to its present value using the risk-free rate R and the time to expiration T. This reflects the time value of money. Lastly, the probability of weighting. The cumulative distribution functions represent the likelihood of the option ending in the money. ND1 adjusts the stock price component, and ND2 adjusts the stock price component to reflect this probability. The key parameters in the model. First, volatility. Volatility is critical in the model. Higher volatility increases the likelihood of option ending in the money, which raises its price. The formula considers past price fluctuations, but it also allows traders to infer expected future volatility, called implied volatility, by solving the equation backward. Second, time to expiration. The closer an option is to expiration, the lower its value. This is because there is less time for the underlying asset's price to move significantly. Last, the risk-free rate. The risk-free rate affects the present value of the stock price. The higher the rate reduces the discount value of K, increasing the option price. Interpreting the results. The Black-Scholes model assumes markets are efficient, meaning prices fully reflect all information, and underlying assets returns follow a log normal distribution. No dividends are paid during the option's life, and risk-free rate and volatility remains constant. Under these assumptions, the model calculates a theoretical price for the option. However, real-world deviations from these assumptions can lead to discrepancies between the model's predictions and market prices. Last, strengths and the weaknesses. First is the strengths. Black-Scholes equations provide consistent and widely accepted framework for option pricing, and helps traders compare options and assess whether they are over or under prices. On the other hand, the equation also have weaknesses. The model assumes that volatility and risk-free rate remains constant, which is unrealistic in dynamic markets. Also, it uses past price data to estimate volatility, which may not accurately predict future movements. Lastly, the model does not account for the early exercise feature, which means the American-style options. Now we're done with the options, and another derivatives we are going to look for is swaps. A swap is an agreement between two parties to exchange the cash flows on different bases on particular date in the future. In this definition, a cash flow is any movement of money into or from someone else's account, such as interest payment, and different basis means that the cash flows are calculated on different underliers such as interest rates, equity prices, or inflation, or it is simply fixed at the start of the contract. There are many different variants of swaps which allow parties to swap the payment that they are receiving or making with another party based on different underlying cash flows. Before we look at the different types of swaps, it is important to understand two key terms, floating and fixed payments. Fixed applies to payments that will not fluctuate over the payment period. These payments are known at the start, for example, receiving 5% interest per year for next 2 years. You can calculate exactly how much you need to pay in the future. The fixed rate may also quotes as the spread above government bond yields. Floating applies to payment that can fluctuate during the payment period. For example, this may include paying interest calculated as the current LIBOR rate. As you can imagine, the amount to be paid each month differs so that there is uncertainty in the future payments. A swaps contract can include any combination of these two payment specifications depending on the needs of two parties involved. The parties involved in these two types of transactions typically include banks, hedge funds, corporations, government entities, and institutional investors. There are many different kinds of swaps, such as interest rate swaps, currency swaps, asset swaps, or inflation swaps. And there is one historical swaps contract that is famous for providing major profits to those who foresaw the 2008 financial crisis, the credit default swaps. A credit default swap, which is a CDS, is an agreement by one party to pay the lost principal and interest of a loan to the CDS buyer if a borrower defaults on the loan. More simply, this contract acts like insurance on the debt obligation, for example, bond. You can enter this contract with a financial institution, OTC, who will pay you the entire value of a bond principal and future coupon payment if it defaults. In return, you pay a fee each set number of days that the bond has not defaulted. CDS contracts can be very profitable, as Michael Burry found it in 2008 when his fund, Scion Asset Management, entered these agreements against mortgage-backed securities. Who would have predicted that the strongest market in the world, real estate, would collapse as the majority of homeowners couldn't pay back their interest repayments? Obviously, the banks that Burry entered this contract with couldn't imagine this, and so his fund only paid a low interest rate in comparison to the huge amount of asset he was able to insure. Eventually, when the housing market did crash, these contracts paid out and he secured over $700 million in profit for his investors. So how do we classify derivatives? Futures and forwards are called vanilla derivatives because the price, expiry, and quantity of underlying assets are fixed as soon as the contract is entered. It may help to remember this by thinking of vanilla having an etymology for basic, implying that futures and forwards are the simplest contracts traded. This is not the case for all derivatives, as we will see with exotic contracts, where any one of these variables may change throughout the contract's lifetime before expiry. We can split the available derivatives into several types: vanilla, simple exotics, and complex exotics. The first class of vanilla derivatives are characterized by fixed terms that do not vary throughout the life of the contract. The terms that outline the derivatives include the time period over which it acts or expiry, the price at which it is delivered for, the quantity and quality of the underlying asset traded. The rule of thumb to follow is that even if just one term of the traditional vanilla structure is broken, then the derivative becomes an exotic. Simple exotics typically have only one term altered, for example an options contract, which can be activated over a range of days rather than just one. For more than one of the terms altered, the derivatives contract is known as complex. The last thing I would like to mention is objectives of using derivatives. The customizable aspect of derivative contracts allows them to be utilized for a wide range of trader objectives. The strategies used fit into three main types of trading: speculating, hedging, and arbitrage. We will now put ourselves in the shoes of each of these types of traders to get better understanding of how the different derivatives described are really used in industry. Hedgers use derivatives to reduce the risk faced from potential future movement in the market. For example, this may be done by purchasing forward contracts for a certain commodity that may be required by a company in a year of time. As we discussed, this has the effect of locking in a price for future payment that a company may not want to risk increasing. Similarly, the hedger may use options to provide insurance against risks. Unlike future and forwards, options contracts offer a way for investors to protect themselves against adverse price movement in the future while still allowing them to benefit from favorable price movements. Speculators act with opposite motives to hedgers. Instead of diminishing market risk, a speculator wishes to take a position in the market, betting that the market will either go up or down. Futures and options both provide a way in which a type of leverage can be obtained to magnify a speculator's potential returns. When a speculator uses futures, the potential loss as well as potential gain is very large. When options are used, the speculator's loss is limited to premium paid for options. Some notable derivative speculators include GameStop retail traders and the legendary Michael Burry, as I mentioned before. We have seen how futures, forwards, and options are priced assuming no arbitrage opportunities. This is usually true, but there is in fact a third type of trader with the capabilities to find market inconsistencies and profit from arbitrage opportunities occurring in derivatives market. Arbitrage involves locking in a riskless profit by simultaneously entering into transactions in two or more markets. Generally, there is very little room for small investors to utilize the arbitrage opportunities as transaction costs wipe out any profit. Therefore, these traders are only really profitable for large investment banks who can access very low transaction fees. And this is all I prepared for the second derivatives lecture, and thanks for listening. This is Louis Kim, the co-producer of IP. Thank you.
Credit to our producers, Aaliyah Friedman, Louis Kim. Head of Marketing, Samhat Raman. Juniors, Ken Zhang, Angie Zhao. Head of Scriptwriting, Alfred Choi. Juniors, Aditya Muthakumar, Kwan Lin. Head Liaison, Lucrezia Poloni. Junior, Ekaterina Vitor. Head of Audio, Isaac Chu. Junior, Cyrus Lee. Head of Sponsorship, Sami Liu and Vladimir Dmitriev. Juniors, Leo Lee, Jamila Tabet, Utkarsh Jetli.